All right, we're just about there, so let's go ahead and get started. Welcome to SolarWorks for Illinois. This is our monthly webinar from Continental Electrical Construction Company. I'm your host, Tim Montague. I do solar sales and business development here at Continental, and it's my great pleasure to have a webinar today about solar finance with CleanView Capital. And our speaker is none other than Stanley Fishbein, the managing partner and co-founder of CleanView Capital. And I'm going to let you take it away, Stan. Thanks for being here.
Well, thank you very much, Tim, and Continental Electrical for having me on today. And good afternoon or morning to our viewers, depending on where you're located. And let's move along because we have a lot of material to cover, and I want to be sure to allow time for plenty of questions at the end. So the great financing debate for C&I solar customers. Should I lease, take out a loan, use a power purchase agreement, or PACE? These seem to be the popular four choices when it comes to the discussion of how a customer is going to pay or finance their acquisition of a solar system. Let's start with a lease. What is a lease? Well, it's really nothing more than just a usage agreement where the owner of property, called the lessor, conveys to another, the lessee, the right to use the property for a period of time in return for a consideration, which is typically monthly payments. There's a purchase option. It has to be exercised. Otherwise, the property must be returned to be in compliance with tax rules and IRS guidelines. These leases are typically triple net, where the lessee is responsible for insurance, maintenance, and property taxes. A lease, a true lease, which I'm describing, is also known as a rental agreement or an operating lease. It is not the borrowing of money, and therefore, the payments are 100% tax deductible, classified as ordinary and necessary business expense under the tax code. So a lease is a usage agreement, but it also can be used as a method of financing where savvy business owners and CFOs prefer to own solar and other clean energy systems when they can obtain long-term value from that equipment and the purchase is affordable. In other words, it fits within the company's budget. A lease is a very efficient way to eliminate upfront capital investment and provide what we call a low-cost path to ownership at an affordable price. So in this way, a traditional operating lease with attractive purchase options serves as a de facto method of financing a company's acquisition of a clean energy system, like solar. So as you may know, the number one problem for most privately owned companies is the monetization of the 30% investment tax credit that's available for solar projects. And these projects are oftentimes not undertaken when a company cannot derive value from that federal ITC. LLCs, S-Corps, they cannot use a tax credit because they don't pay income tax. No tax due, no credit to offset it. And the ITC is passed through to company owners of these LLCs and S-Corps. And even though they may be able to use the tax credit on their personal tax returns, I've had a number of business owners tell me that they're more concerned about conserving cash in the business where it's needed for working capital and other purposes, as opposed to saving personal taxes. Once they realize that they're not giving up value to the other party because the counterparty is claiming the ITC and depreciation. And we'll get to a slide in a moment that will make that point crystal clear. So the operating lease, also known as a tax lease for tax purposes, solves this problem of monetization of the ITC where the lessor, as the first owner of the equipment, claims the ITC and, very importantly, shares that value with the company who's the lessee in possession of the equipment. So let's compare this traditional lease to a bank loan. Well, the lease provides 100% project financing, where if you go to most banks, and by the way, a lot of banks in this country still don't accept solar as an acceptable asset class to lend against. But if they did, they oftentimes want to structure the transaction like a real estate loan. So they'll tell the customer, sure, put 20% cash down and we'll loan you the rest. With the lease, we don't take additional collateral. Oftentimes these banks, because solar is still a new asset class for them, if they will accept it, are looking for additional collateral. And oftentimes they want to lean on the real estate. The lease payments are 100% tax deductible, as I mentioned a moment ago, where on the loan, the customer is only taking a tax deduction for the interest component, which will change from month to month as the loan amortizes over the term. So in addition to those differences, leases do not have restrictive financial covenants, which oftentimes banks will require in their loan documents. And the lease preserves existing bank lines of credit. And it's so important to keep those bank lines available for emergencies or other needs of a business. And I've been counseling CFOs for years. When it comes time to acquire equipment and finance it, that's when you can do a secured equipment financing with a faraway lender and not tie up your bank lines, because if, God forbid, there was a fire and your plant burnt down or some other sort of emergency, you need those unsecured lines of credit to rebuild and help you get out of that difficult situation. And that means you need your bank lines availability as much as possible. So the lease conserves cash, and because the monthly payments on the lease, as you'll see, are much lower than they would be on a loan. Conserving cash is important to a company because the more cash in the lessee's hands improves the balance sheet ratios of the company and the profitability when that extra cash is invested in the business. I like to give the example of the type of company, let's say, that is selling their inventory with a 20% gross profit margin, and they turn their inventory twice a year. Well, instead of tying up cash in equipment, to the extent you can conserve that cash and buy more inventory, you'll generate a 40% annual return on that money. And you can't get a 40% annual return when you tie it up in long-lived equipment. That's just one example of why it's important for companies to conserve cash. Another more obvious one is, to the extent they don't have to draw down as much on their bank lines, then there's an interest savings that they would otherwise pay on those funds that they would be drawing down from their bank line. So leasing is a powerful cash management tool. And I encourage all of you, when you're talking to customers, if we have EPCs and developers on the line, that you need to take a holistic approach to solving or addressing your customers' energy needs, and energy efficiency and so forth has to take into consideration the impacts on the company's balance sheet and profit and loss statements. So let's compare the 7-year traditional lease, which is our lease here at CleanView Capital, to the typical 20-year power purchase agreement or solar industry lease. And I lump the two together because the PPA and the solar industry lease is the same economic model. It's just documented a little bit differently. So the traditional lease has fixed payments with no escalation, and all utility, local, and state incentives are paid to the customer. The full displaced cost of electricity, electric savings, is paid to the customer. There's no lien on the real estate. And those are key differences between the traditional lease and the 20-year PPA or solar industry lease. In addition, the traditional lease is only a 3-page document, where these others are more than 20 pages long and very complex. And also on that note, being an off-the-shelf generic lease that's used for all equipment types, most business owners and their advisors are very familiar with what should be standard industry provisions in an equipment lease. And if you think about it, that compresses the documentation period from perhaps 3 months of negotiation to just a matter of days, as long as it takes for these business owners and their advisors to simply read the few pages. So the traditional lease provides a quick, low-cost path to ownership for these customers and provides greater overall value to the customer than either the PPA or solar industry lease. And we'll get to an example in just a couple more slides. So now let's compare the traditional lease to the PACE program. And there's a lot of excitement about PACE because it's a newfangled type of way to get these projects in place. But PACE does not solve that #1 problem that most privately owned companies have, the monetization of the federal ITC. The lease does solve that problem. In addition, there's no lien on the real estate when you do a traditional lease. But with PACE, there's going to be a tax lien, and that comes ahead of the mortgage lender, which is problematic for some people. There's no interest paid on the traditional lease, as you'll see in a moment, versus a relatively high interest rate with PACE. And I know I've talked to PACE providers who said, gee, 6% interest, that's pretty attractive rate. Well, maybe on a 6 or a 7 year term loan, but over 20 years, that's pretty expensive. And to put it in perspective, if you have homeowners taking out 30-year mortgage loans at 4%, why is 6% on 20 years attractive, especially to a savvy business owner or CFO? I don't think so. Now, one thing that PACE does have going for itself is the credit approval. It's really an equity-based approval rather than a credit-based approval, as with a lease. And that means if a company has lousy credit but a lot of equity in their building, they can probably get it approved for PACE. And you know, that's okay with us. The PACE providers can have all the weak credits. We require what we consider to be a bankable quality credit. And those are the kinds of companies that we prefer to work with anyhow. We are not a lender of last resort. So the lease, again, is a simple, very familiar 3-page document versus a PACE program, which is unknown documents and can be rather complex. Again, addresses the issue of moving the project forward in an efficient and quick manner when you use a lease. A low-cost path to ownership, and a situation where the lease provides greater overall value to the customer because of the ability to monetize and share the value of the ITC than with the PACE program. So let's take a deeper dive, cost comparison of the traditional lease versus a loan. And here, the loan is, we also call it a capital lease. It's a loan and lease clothing, so to speak. Capital lease with a dollar purchase at the end, treated like a loan for accounting and tax purposes. And we offer both types of operating leases and capital leases where it's 100% financing. no cash down. On the operating lease, the customer does not pay any interest. Our current rate on a 7-year capital lease is 6.45%. The monthly payment, you can see, is quite a difference. It's $8,300 a month on the 7-year lease versus $14,746 on the loan. I'll refer to capital lease as the loan so that I don't confuse folks. So 84 payments, you can see the total payments on the lease is much lower than on the loan. And there's a purchase that'll be exercised on the lease in an amount equal to 15% of lease amount, or in this example, $150,000 on this example of a $1 million solar project. So the total all-in payments of $852,950 on the lease is substantially less than the $1,244,000 on the loan. That's because on the loan, the customer is paying back the $1 million plus interest. But what's very interesting about this cost comparison is on an after-tax basis. Last point, on a pre-tax basis, you can see how the operating lease conserves cash for the business very clearly. Let's look on an after-tax basis, and we're using the current 21% tax rate for corporations here for purposes of this example. With the lease, the customer is not claiming ITC. The customer's monthly payments are 100% tax deductible. So $697,000 of payments times the 21% tax rate generates $147,000 in tax savings. Maker's depreciation comes in at the end. The depreciation rules, most people don't realize this, basically is a way for a company to write off its investment in equipment. And so on that point, the customer isn't entitled to write off their investment until they make an investment. So at the end of this lease, when the customer purchases the equipment for $150,000, they're going to write that off. And they're going to write it off using the 5-year maker's depreciation. So $150,000 times 21% tax rate saves $31,500 in tax savings. A quick note, you may know that we have 100% bonus depreciation now. That's scheduled to revert to 5-year makers 5 years from now. So when the customer acquires ownership at the end of the 7th year and after this lease, most likely they'll be using the 5-year makers depreciation. On the loan side, the customer claims the 30% ITC, which saves $300,000, and obtains an interest rate deduction. So $244,000 of interest times 21% saves $50,000 in taxes. And the customer here will be entitled to the depreciation on 85% of the lease amount, because the tax law requires an adjustment for the equipment cost reduced by 50% of the tax credit, which means 15% of 30 is half, and that ends up with 85% of project cost times the 21% is $178,000 in tax savings in the first year now with bonus depreciation. But look at the bottom line difference. $714,000 is the after-tax cost if you use a loan, versus $673,000 is the after-tax cost with a lease. And while this demonstrates that the operating lease is lower cost than the loan, the more general point is that the customer is not giving up a lot of value to the other party because the other party is claiming ITC and depreciation initially. Excuse me. So that's the traditional lease versus a 100% financing loan. let's go to the next slide. And so what we've done here at CleanView Capital is we've created what I call the Clean Energy Ownership Program, emphasis on ownership, because it's really designed for a company that wants to own a solar system and really not intended for a company that just wants to use a solar system for 7 years and return it. Believe me, we don't want it back anymore, then they don't want to take it off their property and return it. So the ownership program has a few components to it. We have a 9-year investment strategy, which we call lease and loan to own, which consists of a 7-year traditional lease to create that low-cost path to ownership, and a strategy where the customer will finance their purchase at the end of the lease with a follow-on 2-year loan to maintain low monthly payments equal to or lower than what they were paying during the lease, and in that way helps them conserve cash. Now, the customers in our program are free to come back to us or any lender in the country and negotiate interest rate, but frankly, my experience over the years has been interest rate is not as important as maintaining that low monthly payment. They also have the flexibility of paying off that purchase price sooner or later, depending on their need for cash in the business. The other aspect of the program is we give customers a choice as to how they want to handle the vendor's progress payments. They can advance cash and we'll reimburse them and start the lease after the construction period. They could take a construction loan from us or their bank and pay interest. Or the third alternative is if they elect to start the lease early before completion of installation, we'll make all those progress payments to the contractor and we don't charge the customer any interest. The reason being that they've already started the lease and every month they'll be making their lease payments during the construction period. Now, if you were a customer, I know what you're thinking. Why would I want to be making monthly payments during the construction period? I'm not obtaining my electric savings. I don't have any SRECs or other incentives coming in. Why do I want to start it early and start making payments? Well, there are 3 reasons why. The elimination of interest during the construction period is real cost savings. There are no additional monthly payments, just the 84. So the sooner you start your payments, the sooner you finish and obtain ownership, which is your objective. And the third reason is because those monthly payments are 100% tax deductible, if you make a few extra payments in the current year, so you have a little bit greater tax savings in the current year. For those 3 reasons, essentially all of our customers elect to start the lease early. And that's a real differentiator, by the way, because I'm not aware of another solar lease in the marketplace that gives that choice to customers. And by the way, all of the public companies that we've dealt with have also elected to start the lease early, again, for these 3 reasons. So the Clean Energy Ownership Program is not just for solar. You can combine batteries, wind, even CHP energy systems, and microgrids. We recently used this 7-year lease for a microgrid that was installed in front of the meter by Ameren, Illinois, and it was very attractive to them. And so we can look at projects of this kind in front of the meter as well as behind the meter. Again, with our lease, there's no upfront capital outlay. The payments are 100% tax deductible. They're fixed. There's no escalator. No interest paid during the construction or lease periods when customers elect an early start. And the ownership is at reduced prices after the 6th and 7th year. Yes, we give the customer 2 bites at the apple. They have an opportunity to purchase the systems that they're leasing at either the end of the 6th or 7th year. So again, just a quick recap, then we'll go on to another example. Companies keep all the electric savings, which is much greater than what you typically see in a PPA, which at most only provides 20% cost reduction. Customers achieve a low levelized cost of energy over the life of the equipment. We show that in our 25-year cash flows that we run for customers. And so you have to be looking at the cash flow over the life of the system and not over this relatively short lease period to get an accurate sense of what the economics to the customer will be. All the RECs, renewable energy credits, all environmental benefits, all for the customer. We don't take any of that away. All incentive payments, whether they're grants or performance-based incentives, are all for the customer. And our customers obtain valuable tax benefits as well. So even though they're not claiming the investment tax credit and the initial depreciation, instead, they're obtaining 100% tax-deductible monthly payments, and they write off through depreciation their purchase option price. And you saw that in the cost example, that there's plenty of tax benefits and value, real value there for the customers who are doing the operating lease. This is just a sample of how we prepare cash flows for projects, where we have an input area. Our contractors fill out a cash flow request input form, send it in. It populates this project summary area up on the left. And I'm not going to go through this in a lot of detail because I want to leave time for Q&A. But we'll show the 7-year lease summarized here, and then the follow-on loan, and then lease and loan totals. So that's sort of an overview where you have project cost $500,000, lease amount of $500,000, so 100% project financing in essence. And the combined totals of all the lease payments and the loan payments are over here, $437,000. That's all before tax, the total of the customers, all in payments, which is only about 87% of project cost. So you can see the customer is not even paying full principal. The project was $500,000. By the way, this was a real example that one of our contractors in Illinois had sent in recently. And so we show the electric production, the utility savings based on the inputs in this area. There's SRECs in Illinois, so there's net cash flow. We show that now against the lease payments and the loan payments for a column which is headed before tax cash. Then we go to an after-tax area where we show the tax savings on writing off the net less all payments, the tax savings from interest, and tax savings from depreciation after the customer acquires the ownership of the equipment. In the far right-hand column, we have in amount invested as a percentage of project cost. And this is a very good way to present the project to potential customers, where you have a situation where they have some money invested. And that's exactly the point here. But let's come back to that in a second. I want to drop to the bottom and show the key financial metrics, the reason why companies want to obtain ownership of this solar system with our lease program. I should say ownership program. The levelized cost of energy of 5.4 cents is a 40% reduction from this customer's 9 cents a kilowatt hour rate. That's a double or more of the savings you'd find in a PPA program. The before tax cash flow, $146,000 on a $500,000 project. That's the, I'm sorry, net present value. $429,000 total cash flow, $146,000 in today's value, which means as soon as this customer flips the switch on his solar system, he's increased his property value by $146,000. and it's approximately a 18% internal rate of return. And whether you look at it on before tax cash or after tax cash basis, it's comparable. And these are the reasons for the customer going forward and making an investment in ownership of solar in this fashion. Not the fact that they might have a relatively small amount invested along the way to ownership. And that's why we have this column, amount invested as a percentage of project cost. Because if you think about it conceptually, for the customer to achieve these attractive metrics at the bottom of the cash flow means they have to be prepared to invest 15% of project cost in ownership after this lease. So having said that, it shouldn't bother them that they have a relatively small percentage invested along the way to ownership. And when it's presented in this fashion to savvy business owners, you don't get pushback because they have so-called negative cash flows in the early years. It's a much better way and more accurate and correct way to present it to the customer when done in this fashion. Okay, so that does it for my slide presentation. And we're going to have plenty of time now to take questions on any of these slides or anything else you care to ask.
Great, thank you very much, Stan. And to all the attendees and listeners, what you can do is raise your hand. So if you move your cursor, you'll see a little raise your hand symbol, and then I can unmute your mic and you can ask the question of Stan or myself. And then if you prefer, you could also type that in the Q&A tab, which is also there at the bottom of your screen, most likely. But yeah, let's get some questions. You know, solar finance is a fairly deep subject, so it will take you time to understand both the operating lease that Stan's company, really focuses on, and then of course the other major methods, cash, loan, or PPA. But still waiting for people to raise their hand or chat in a question in the Q&A tab at the bottom. I'll go ahead and ask you a question, Stan. What are some of the objections that project owners have with equipment leasing, and how do you answer those?
Okay, good question. First of all, our lease is directly to the end user customer. We don't provide leases to developers. But having said that, some of the customer objections that we've heard over the years is one, unfortunately, a number of companies may have had a bad experience with a leasing company in the past with a computer or other machinery, let's say, for their factory, or where customers are taken advantage of by unscrupulous leasing companies who do a variety of things, the most noticeable playing games with fair market value purchase options. And the number one question that comes up with our customers when they hear that we have a fair market value feature at the back of our lease is, how do I know, well, let me just say, the purchase option at the end of the 7th year with the solar lease is the customer has the right to buy the system at the greater of 15% of lease amount or the system's fair market value. And we don't cap the fair market value. Why? Because we know that IRS likes to see a fair market value at the end of the lease. And with that kind of language, there's no question we're going to pass muster. It's a fair market value lease. But it always raises this concern among customers. How can I trust these guys that they're not going to try to take advantage of me, come back with a fair market value greater than 15%? And to that I respond, rather than say, trust us, that's not our game, we created a back-end structure that has totally eliminated that risk, totally eliminated that risk. And the way we've done that is by providing the customer with a fixed price early buyout option at the end of the 6th year in an amount equal to 26% of lease amount. And so in our materials, we show if they make 72 fixed payments and have the fixed 26% buyout at the end of the 6th year, that their all-in payments are essentially the same as if they go 7 years of payments to the 15%. And in our materials, path to ownership, we state that the customer can agree with us in the 6th year as to what the amount of their buyout will be at the end of the 7th year. What I'm saying is, if we don't give the customer a letter agreeing to 15%, I don't know why we wouldn't, but if we didn't, they buy out early at the fixed price of 26% and have essentially the same all-in payments as if they went the full 7 years. And that's a real differentiator between our lease and others that I've seen in the solar market. And that's how we address the number one question that every customer is going to ask when they take a look at our lease and they hear it has a fair market value feature at the end. And that's why we've put it in writing.
Great. We have a question from Jeffrey. What financing model should a K-12 public school consider? And then a follow-on question from Jeffrey. What financing model should the public sector use to acquire solar?
Okay, very good question. So tax law does not allow a lessor to monetize ITC when the lessee is a tax-exempt entity. That came into the tax code in the 1986 Tax Reform Act when the government was clamping down on a lot of tax shelters and tax abuse. I don't see that being changed. And so the alternative forms of financing that's available for schools and other non-for-profits is a PPA, power purchase agreement, or a loan or capital lease. Now, on that note, because of the popularity and the use of those other products in that marketplace, we are about to launch a 10-year financing term for these tax-exempt entities. And I believe will be very attractive because it will recognize the tax-exempt status of these governmental entities and their divisions like school districts, water districts, et cetera, so that we will be able to provide an interest rate that's reflective of their tax-exempt status, which will be below a commercial interest rate. So touch base with me about a week from now. I anticipate having that program.
So for nonprofits, the PPA or outright purchase is the way to go. And then the other thing for people to distinguish is a capital lease versus an operating lease. A capital lease is much more akin to a loan, and an operating lease is what Stan has focused on for us today. So thank you, Jeffrey. That was a good question. Any other questions from our listeners? Please don't be shy. We have no raised hands right now, so there's plenty of room, or you can chat into the Q&A box. Stan, the Illinois market is obviously a new market. We have 100 megawatts of solar PV in the state today. We're going to see the addition of 3,000 megawatts now, thanks to the Future Energy Jobs Act. What can solar installers do, though, to further engage with the broader finance community? I got lucky, and I met you at the Midwest conference 2 years ago. I just happened to be grabbing lunch, and you were sitting next to me, and we started chatting. I don't know if you remember that. I was brand new in the industry at the time. And so I've stayed in touch over the years, and you are one of the more prominent solar leasing, for capital leasing companies that I'm aware of. But if you could say anything to the installers and system, potential system owners, I guess. How can they further engage with you or the greater market?
Well, good question, and that triggers a thought, and that is this monetization of ITC is going to be a bigger problem this year and going forward than it has been in the past. The reason being that, first of all, the value of the depreciation is worth a lot less with the reduction in income tax rates. And also, with the reduction of tax rates means lower tax liability in which to offset with an investment tax credit. So restrained capacity of tax equity, I think, is going to start showing up in a lot of these power purchase agreements where, they're going to have to make some adjustments to their pricing model in order to provide their investors, not only tax equity investors, but lenders, with the type of returns that they have been accustomed to, and still provide the customer with their nominal electric discount of 10, 15, 20%. And also on that note, as you all know, the Federal Reserve has penciled in a number of rate increases over this year and the next couple of years. And that also is going to impact all types of financing, not just the PPA, but loans and even leases. All these payments are going to be going up, which is all the more reason why customers need to get off the dime and start these projects and line up their financing as quickly as possible.
Okay, we have a question from Pete. Is $100,000 the minimum amount CleanView will lend?
Yes, it is. For efficiency reasons, we've drawn the line at $100,000.
Yeah.
Have the funding capacity to do much, much more.
And in the solar world anyway, that's a relatively modest commercial system. I mean, they do, of course, get smaller. A small system would be $50,000, and then so the $100,000 system is still at the smaller end. But good question, Pete. And
if I can also do a follow-up to that answer for Pete, one of the reasons why we drew the minimum at $100,000 is because we need companies of a certain scale in order to pass our credit parameters. So a business that's only doing, $500,000, $600,000 annual revenue is not going to have the kind of cash flow to support taking on, $100,000 or more of lease debt. We're really looking for companies doing around a minimum of $1 million or more, which we find will have the financial characteristics and cash flow that we require in order to do a project with us.
That makes sense. We currently have no questions, so please get your questions in, raise your hand, or chat in a question, or go to the Q&A tab. I will make a couple of announcements. We do this on the last Tuesday of every month, and our April 24th program is going to be solar storage, or solar plus storage, with Brian Haug. He's the director of our energy group here at Continental. He and I will be talking about how you can pair solar with lithium-ion storage, and that is a very fast growing industry, as you know. So we look forward to hearing about the Illinois market for solar and storage, the broader market, and then we'll give some examples of some specific projects that Continental has accomplished in the last couple of years. Then on May 29th, we're going to have a webinar dedicated to community solar. I am looking for a guest speaker, so if you are a community solar developer and are interested in coming on the webinar, please let me know. We would love to have a developer. Continental is an installer, not a developer, so we partner with developers on these community solar, which are landscape scale projects of about 10 to 20 acres. All right. Well, if we don't have any other questions, Stan, is there anything else you'd like the audience to know before we go?
Only that we're active nationwide. We do a lot of projects in the Midwest where you have a low cost of electric, as well as along the East and West Coast, where there are oftentimes state and local incentives to supplement the electric savings. But wherever you are, we have you covered. And because we do not take these incentives and payments away from the customers, it's an attractive proposition wherever you might be located. So happy to work with all of you. Look forward to hearing from you folks offline.
Yeah, and obviously you have Stan's contact information there, and his colleague Alec Olembeski, who's based here in Illinois. And you can also just reach out to me, and I can put you in touch with Stan and Al as you choose. You can find me at tmontague@cecco.com. And thank you so much, Stan, and to all our viewers and listeners. We will see you in a month.
Sounds good. Thank you, Tim.
Have a good day.
You too. Bye.